The IRS gives you two ways to save for retirement, and most people pick the wrong one. One saves you money today, the other could save you hundreds of thousands over your lifetime. By the end of this video, you'll know exactly which one is right for you. Most people weren't taught how money works. They were just taught how to work for it. Welcome to Fiscal Fluency. Today we're translating one of the most common questions in personal finance. Roth IRA versus traditional IRA. Same contribution limit, completely different tax strategies. Let's break it down. Quick reminder before we dive in. I'm not a financial advisor, and nothing in this video is financial advice. This is purely for educational and informational purposes. Always do your own research and consult a qualified professional before making any financial decisions. With that said, let's get fluent. First things first. IRA stands for Individual Retirement Account. It's a special type of investment account that comes with tax advantages specifically designed to help you save for retirement. Think of it as a container. You open the account, and inside it, you buy investments like index funds, stocks, or bonds. The IRA itself isn't an investment. It's the wrapper that gives your investments tax benefits. In 2026, you can contribute up to $7,500 per year to your IRAs if you're under 50, or $8,600 if you're 50 or older. That's the combined limit across all your IRAs, not per account. Now here's where it gets interesting. The government gives you two flavors of IRA, and each one handles taxes completely differently. That choice, Roth or traditional, can mean a difference of tens of thousands of dollars by the time you retire. Let's start with the traditional IRA. The traditional IRA is the tax break now option. When you contribute money to a traditional IRA, you can deduct that amount from your taxable income this year. If you earn $60,000 and contribute $7,500, the IRS treats your income as if you only made $52,500. That saves you real money on your tax bill right now. Your money then grows tax deferred inside the account. You don't pay capital gains taxes, you don't pay taxes on dividends, nothing. It all grows untouched. But here's the catch. When you withdraw that money in retirement, after age 59 and a half, every dollar that comes out gets taxed as ordinary income. Your contributions, your gains, all of it. And there's one more rule you need to know. Starting at age 73, the IRS forces you to start taking money out whether you want to or not. These are called required minimum distributions, or RMDs. You can't just let it sit there growing forever. Uncle Sam wants his cut. So to recap the traditional IRA, tax deduction going in, tax deferred growth, taxed on the way out, and mandatory withdrawals starting at 73. Now the Roth IRA. The Roth IRA is the pay taxes now, relax later option. With a Roth, you contribute money you've already paid taxes on. There's no deduction, no tax break this year. You put in $7,500, your taxable income stays the same, but here's the magic. Your money grows completely tax-free. And when you withdraw it in retirement, tax-free. Not tax-deferred, tax-free. Your contributions, your gains, all of it. You already paid your taxes in the front end, so the IRS doesn't touch it again. And unlike the traditional IRA, the Roth has no required minimum distributions. You never have to take money out if you don't want to. You can let it grow for decades or pass it on to your heirs. There's one more advantage that makes the Roth uniquely flexible. You can withdraw your contributions, not your earnings, just what you put in, at any time, for any reason, with no penalty and no taxes. That makes it a surprisingly useful emergency backstop, though you should try not to touch it. But the Roth does have one major restriction. income limits. In 2026, if you're single and earn more than $168,000, you can't contribute directly to a Roth IRA at all. For married couples filing jointly, that ceiling is $252,000. If you earn between $153,000 and $168,000 as a single filer, your contribution gets reduced. So to recap the Roth, no tax deduction going in, tax-free growth, tax-free withdrawals, no RMDs, and income limits on who can contribute. All right, now for the head-to-head. Let's run the numbers and see which one actually puts more money in your pocket. Meet Sam. Sam is 30 years old, earns $60,000 a year, and is in the 22% federal tax bracket. Sam contributes $7,500 per year to an IRA for 35 years, earning 8% average annual returns. Let's compare both options. Both accounts grow to the same amount inside the IRA, roughly $1,292,000. But what you actually keep is where the paths split. With the Roth, Sam keeps every penny, $1,292,000, tax-free. With the traditional, Sam got a tax deduction each year, saving $1,650 annually. Let's be fair and assume Sam invested those savings in a separate taxable account. After 35 years, that side account grows to about $250,000 after capital gains taxes. But the $1,292,000 inside the traditional IRA gets taxed on the way out. If Sam is still in the 22% bracket, that leaves about $1,008,000. Add the side account. The traditional path totals roughly $1,258,000. So at the same tax rate, the Roth comes out ahead by about $34,000. Not a massive gap. But here's where it gets interesting. If tax rates go up, say Sam's retirement bracket rises to 32%, then the traditional IRA is worth only $879,000 after taxes. Total with the side account, about $1,129,000. The Roth still has its full $1,292,000. That's a $163,000 advantage for the Roth. Now flip it. If Sam retires in a lower bracket, dropping from 22% to 12%, the traditional IRA keeps $1,137,000 after taxes. Total with the side account, about $1,388,000. Now the traditional wins by $95,000. That's the core trade-off. If your tax rate will be higher later, the Roth wins. If it'll be lower, the traditional wins. And if you're in the same bracket, the Roth has a slight edge because of how the side account gets taxed. So, how do you actually decide? Here's a simple framework. Choose the Roth IRA if you're early in your career and expect your income to grow. If you're in the 12% or 22% bracket now and anticipate being higher later, locking in today's lower rate with a Roth is a smart move. The Roth also wins if you want maximum flexibility. No RMDs, penalty-free access to contributions, and a clean tax-free inheritance for your heirs. Choose the traditional IRA if you're in your peak earning years and in a high tax bracket right now. If you're in the 32% or 35% bracket today and expect to drop to 22% or lower in retirement, the traditional IRA's upfront deduction saves you more than you'll pay later. It's also your only option if you earn too much for a Roth, though there is a workaround called the backdoor Roth that we'll cover in a future video. And here's a third option most people don't consider. Do both. You can split your $7,500 between a Roth and a traditional in the same year. If you're in a middle bracket and genuinely unsure where rates are headed, diversifying your tax exposure across both account types is a perfectly valid strategy. Think of it as tax diversification, the same way you diversify investments. No matter which you choose, the most important thing is that you're contributing something. The difference between a Roth and a traditional is meaningful, but the difference between either one and nothing is life-changing. Let's recap your new vocabulary. An IRA is a tax-advantaged investment container. The traditional IRA gives you a tax break now, but taxes you in retirement. The Roth IRA taxes you now, but lets your money grow and come out completely tax-free. The right choice depends on where your tax bracket is today versus where you expect it to be in retirement. And if you're unsure, you can use both. If this video helped you decide which IRA is right for you, hit subscribe to Fiscal Fluency. With every topic, we translate another piece of the financial world into something you can actually use. Next up, we're decoding credit scores. What actually matters and what's a total myth. Stay fluent. I'll see you in the next one.